Suddenly, the labor market is not looking as weak as investors thought. I'm Lisa Bernhard with Reuters, and joining me today is Liz Miller of Summit Place Financial Advisors. Liz, today we got jobless claims numbers for last week, and they were lower than expected. This is kind of a reversal from what we saw in the non-farm payrolls report, the monthly report on Friday that showed that hiring had slowed and, of course, led to that big stock sell-off. And then last week's weekly jobless claims were also higher than expected. What is going on with this data? What do you make of it?
Well, the first thing I want to say is remember, our employment data is always backward looking, and we're all reacting, trying to look forward. And that's difficult. But the unemployment claims come out a lot more often, and so they feel like they give us a better pulse of the moment. 8,000 less people filed for unemployment than the estimate was, and that was strong enough to improve the market. I think that's a piece of it. I don't think it's all of it. I think the employment report from last week that started this volatility partly was, I think, that spark with a lot of investors still thinking about what the Fed had just said off of the meeting, a couple weeks ago, that even though there's evidence of slowing, there's evidence of stabilization, we're going to keep waiting. We're going to keep waiting. So I think a lot of US investors really have felt, just like on the way up, the Fed is a bit behind the eight ball on the way down. And so I think that's also part of what kicked this off. The employment report was just yet another, well, gosh, here's your darn hard data you keep talking about that's looking backwards. And we all know when you do start lowering rates, it's going to be 6 months before it flows through the system. So I think we're getting some volatility with dog days of summer, frustration, heat, enough of this kind of feeling.
Okay, so I think to your point, that already has many investors thinking about what Jerome Powell might say in Jackson Hole when the Fed meets later this month. Are you already thinking about that, or what do you anticipate?
We are absolutely thinking about now, what does Jackson Hole look like? We got a clear message from Powell in July that was, if anything, a little harsher than expected. So I think investors, particularly in the bond market, are now jumping ahead and saying, let's wait and see what comes out of Jackson Hole. Sometimes Jackson Hole is a yawn and we get nothing new, but certainly it feels like this summer, with a lot of different data pointing to stabilization, there's the question of, is the Fed going to start putting more priority on its growth mandate than its price mandate? And that's what we've seen in the rest of the world, where other countries have started lowering rates earlier. It was really a tacit conclusion that growth was now more important than price stability. So waiting to see if we get any statements out of Jackson Hole that give more clarity to where we're going and when.
Stocks are up a healthy amount right now. Wall Street's main index is. What else other than the weekly jobless claims number is driving that upward momentum?
We're seeing a good bounce back today, and I think it's certainly on the unemployment numbers this morning, but I also think it's just this heightened volatility. Along with the employment report that kicked off this volatility, we also had Japan making its big move. And we've talked a lot about unwinding of the carry trade across Wall Street. Well, when we unwind that trade, we kick a lot of things around in the markets, and we also raise a lot of cash. So I also think what we've seen today is a little bit of a sigh of relief with the unemployment numbers, or new unemployment numbers, I should say, and then a chance to go in and pick up some favored stocks at prices that look kind of attractive now. Overall, we hit 10% off the market high. That's very typical in the middle of the year, but it's also an attractive entry point as people are still pondering what they want to own.
So let's pick up on that. You, as a portfolio manager, wake up on Monday morning and you see that there's been this global rout in stocks, and you see that the indexes here are starting to really plummet sharply. First of all, what's your mood? What's your thought? Are you, uh-oh? Are you like, I've seen this before? Are you thinking, what are you thinking? What is your mood?
So my first move is, yeah, we thought this was coming. We've been talking with our clients for a number of months that we weren't going to be surprised with volatility, particularly this summer. Those of us who've been doing this a long time know that it's not unusual in August. So you're already spending your summer anticipating what might be the drivers, what could kick it off. And I find that often what kicks it off is something that you think you've addressed a million times already, you think you've thought through, but that particular morning, it's the straw that breaks the camel's back and the market starts showing a lot of volatility. The next move is we're immediately looking at the portfolios, right? We're immediately thinking, where have the indices moved? Where's support going to be? How far have individual investments moved from previous highs, from where we see the value? And, reassessing that nothing has really changed in our investment approach, which at this kind of volatility is typically our conclusion. It's not unusual for us to look at this and say, everything we were looking at in the economy and expecting for the year is still generally on trend. What we're seeing is some market mashups.
So were you a buyer on Monday? And can you tell us where, if so?
Across the portfolios, we were doing some buying. We had been starting beforehand, certainly looking at, within the things that we own, some of the big tech where we've been cautious for new positions, taking the opportunities to say, 10, 15% down, we're more comfortable making sure the portfolio has that allocation. Some of the more discretionary, that's also an area that's been hit a lot, making sure those are full because we still see that strength sort of 6 months out from today. So not really looking for the quick bounce kind of trades, but areas where we'd been building positions and we felt this was an opportunity to finish out that building.